Hey guys, Chris Haddon here with the Hard Money Mastermind with a very, very cool industry interview for everyone in the group. We have a special guest. His name is AJ Poulin from Applied Business Software, the makers of the Mortgage Office. AJ, thanks for being with us.
Chris, thank you for having me.
Good to talk to you again. You know, we've actually, I'm going to throw out some dates here, but we've probably known each other for over 10 years at this point. I actually met AJ, quick backstory, and then we'll start diving into the stuff, at the first industry event that we ever went to. It was the Pitbull conference. This would have been like January, February of 2008. And I think by that time we had closed one hard money loan.
One loan.
One loan. And then we were on a plane to Vegas to figure out what this whole industry was about.
You're kidding. I didn't know that. So that was 10 years ago.
Yeah, 10 plus.
10 plus. Well, time flies.
Time does fly. It's been good though. It's been a good run for us, for you as well.
I remember harassing you for a very long time to purchase our system, and you kept being politely pushing me off.
Well, you're
always polite about it.
Your follow-up is terrific. You're a great salesperson, what can I say? And eventually we did come on as customers and been super happy with the software too. Mind you guys, this is not going to be a big, long software sales pitch. We have a number of different things to cover, software just being one of them. AJ, if you wouldn't mind, could you give us a little background, intro, and how you got into the hard money world?
Oh, man. So my company's been around for 40 years. I've only been here half that time. I'm on year 20, so I'm still considered one of the new guys here at the company. Company was created back then for private money lenders that were managing loans. And back then, technology was new and computers were new. There were no personal computers. There were no laptops, let alone iPads, cell phones, any of that stuff. It was giant systems. And then the software was loaded into the system. And you pick the system, put it in a truck, and you load it. You know, it was crazy. And then I went to DOS, and then I went to 5.25-inch floppies, then I went to CDs. And so it's evolved quite a bit. So, but the system was made for private lenders. The funny thing is we also adapted to in industries like we sell to universities, Pepperdine University, UC school system. We sell to nonprofits like Habitat for Humanity. We sell to cities like City of Beverly Hills. But in general, if somebody's making a loan to somebody else, our system can handle it.
Got it. Interesting. So it started specifically with the real estate private lending and expanded out?
Yeah. And the funny thing is we don't really do much to it to attract these other types of industries, but it's flexible enough that they're drawn to it. So for example, I think the first Habitat that had our system, they had like a couple thousand loans in the books, and they were the first one to buy it in Habitat Miami. And it's a small community. So people talk good if something's good, and they talk bad if something's bad, but the system worked well for them. And so that's how we kind of got into the Habitat world. Same with cities. I think the city of Boise was one of our first customers in the city world. So now we've got a bunch of cities that use our system, Jacksonville. And then the schools, we have people that finance aircraft. We have people that finance firearms. We have people that finance equipment, cars, student loans, dental work. I mean, all the way from $50 payday loans to $500 million, literal $500 million development deals, 5 acres in Toronto. So
wow.
$50 to 500 million. It's just more zeros in the software, right? The math is still the same.
Yeah, and the job is still the same.
That's right, yeah.
You know, we say that about doing loans too. Like you could do a $50,000 loan or $500,000 loan. It's pretty much the same process, right? Only you're going to make a lot more money when you have more zeros.
You'll make more money with more zeros. Sometimes the smaller loan amounts have bigger problems, but you'd probably weigh in more on that than I could. Sometimes when someone starts out being a haggler, they're always a haggler. Mm-hmm. Right? Certain rules, things we've learned over the years.
All very true. So, okay, bringing it back to the real estate world and the private lending world in particular, I thought this would be a really cool conversation because you have a very unique perspective on the industry. Most of us as a lender, we talk to our clients who we lend to, we talk to our investors who invest money with us, our team. Mm-hmm. On occasion, we'll chat with another local lender who we're friendly with, but you really see behind the scenes. You personally see behind the scenes of lenders all over the country, and you have for a long time. Talk a little bit about that, if you could. So some of the different ways of doing it.
I got to tell you, when I started, so it was my 20-year anniversary last fall, and the interesting thing is that back then, everybody was doing owner-occupied mortgages. So you made a loan to somebody living at the property, and they wanted to get a new roof or make an addition or buy a motorhome or whatever. That was basically, you're making loans to be able to live in the property. And a lot of the loans were seconds, home equity lines of credit.
Yeah.
Home values were going up, and people were like, wow, I've got all this equity sitting there. Might as well take some of that and, buy something, right? And back in the day, I think it was 10, 11, 12 years ago, we had one customer doing rehab loans. So out of hundreds and hundreds of customers, we had one customer doing rehab loans in California, the Norris Group. And I didn't even know what it was. I didn't even know what rehab loans were, because I'm like, what are you talking about? This is, people are doing seconds and home equity. And so he brought me to his office. They bought the system, and he gave me this book, The Coming Foreclosure Crisis. And I was like, what is this? He goes, well, based on this and building permits and this and that, the market's going to crash. And, all the home value is going to drop 50%, and here's what's going to happen. And I'm like, this guy's crazy. I'm like, this guy's totally crazy. And he's showing me all this data and all this research that he's done. I'm going, he seems smart, but he's crazy. So, 2 years later, the market crashed. Everything he said was going to happen happened. And then that was really the birth of rehab lending, because nobody wanted to make loans to people that lived in the property, given these new rules with Dodd-Frank, the CFPB, RESPA, and things like that. These rules did two things. They bailed out the banks, so the banks got stable. That's number one. Number two is they stopped the banks from lending to consumers, right? They made it very, very difficult for a consumer to get a loan. So what happened was private lenders, I always do these speeches across country, but they're chameleons, meaning they'll adapt to any marketplace, and it's really the world's second oldest profession, and you can probably figure out the first one. It goes back to literally the beginning of time. Lending. And it wasn't always viewed favorably. Plato, equated private lending to, sleeping with a donkey or murder. So if you lend money or you sleep with a donkey, it's the same. And so, but private lending has always existed because there's always been a need. People always need access to capital. They always have. They always will be. It's one of life's few constants.
Richest man in Babylon, right?
That's right. So this, lending, taxes, there's certain constants in life, and that's one of them. So the private lenders back then figured out a way to make loans. They made loans to people that were buying these properties on the auction block that were fire sale prices that were falling apart. The borrower lost their home, and because they couldn't pay, they lost their job. So there was a property, the bank didn't want it, it was falling apart. And the private lenders are like, what, well, you know what? This guy wants to buy it and fix it up. Well, I guess I'll give him a loan for that. What do you think you can sell it for? And that's really how the whole rehab market started. And the fascinating thing is 90% of our customers now, fast forward 10 years,
right?
Almost all of them, 92%, 90% are all doing rehab loans. And it's very attractive. It's, you're not dealing with a borrower that's going to say, you're trying to kick me out of my home. You're dealing with an investor who's just trying to turn a profit. The sooner he fixes a property and fixes it up and makes it all nice and pretty, he can sell it, get his money back, pay you back, the better off for them. So they have a vested interest to make this work. And that's why it's a great business model, first of all. The second thing that's a great business model is that you've got recurring borrowers. A rehabber may come to you for one loan and it works out well and he made some money. He's like, wow, Chris was really nice to work with. And well, here's another property. So they may have 3, 4, 5, 6, 7 loans out at any one time.
Sure.
So if you're a lender, lending to the rehabbers, it's a great business model because you repeat borrowers, just like Starbucks, right? Keep coming back for the same stuff. Good business model.
Absolutely. Yeah, and that timing's interesting too. Like we got in around the time, like right after the crash. So we closed our first loan at the end of 2007. December 2007, it already crashed. We had launched our company shortly before that. We were transitioning into the investment lending world. And that's where we wanted to be. Like we always wanted to be B2B. Like that's where we felt most comfortable business-wise and everything else. And it was rehab loans and small commercial bridge loans since day one. But that being said, I know that my business partner, Jason, he did work for a company that did a lot of those hard money primary residence loans with the license and everything else and the certain disclosures. And he had that experience. But once we launched HMB, it was just investor world only and looking for those great clients that come back every month, every quarter.
But see how stable that is? I mean, dealing with the consumer, for better or for worse, there's X factors in wealth, but they're not necessarily business people. They live in a home, they own a home, they have a job. They lose the job, they can't make the payments on the home. right? What are they supposed to do? And if it's a bad economy and 8% unemployment, and they're kind of up the creek, right? They really don't have a lot of options. So you're dealing with that. Not fun. With a rehabber, it's just a whole different world. That's why it's such a strong business model. Any business where you can rehab repeat borrowers, people saying nice things about you, telling their friends, they get in on the action. Everybody's making money. I mean, there's no real downside. You know, if the market tanks, yes, but right now there really isn't a ton of downside other than rate compression. But I don't know if you see that in DC. That's some rate compression going on in California.
Oh, we have. It's happened big time in California. Yeah, let's get into that because that's very relevant to the time frames and everything we're talking about, the shifting. Since we got in the business, 10, 11 years, we've been on a good run, right? And over the past few years, it's kind of leveled off because so much competition's in the market now. Mm-hmm. There are probably 5 times the number of lenders, literally 5x, than there were like 6-7 years ago, I would have to say. They just come out from everywhere. And it's because of the good market, good real estate market and low interest rates, institutional money has jumped into the hard money space for the first time ever. Mm-hmm. No one's ever seen it before. And so oversupply of capital means that more people can get in the game and then the price line comes down, right? Econ 101.
Yep, absolutely. And it's true. Before you started, so you started 10 years ago, right? Prior to 10 years ago, there were a lot of banks that provided warehouse lines to private lenders. Capital One and a lot of the big banks actually provided warehouse lines to private lenders.
Is that right?
Yeah. And then they started pulling them like a year before the crash. So they were in it before, and then they got out of it. And then time heals all wounds, Chris, right? Bygones be bygones. Right. History is history. That was way back when. They're all back now. What you said is absolutely true. The Wall Street money and influx of capital is unprecedented as far as scope and size, for sure.
Yeah, I mean, we probably for the past, call it 3-4 years, we've had Wall Street firms and other areas of the country, finance companies approaching our company to try to give us money. Uh-huh. Whereas when we were, mind you, this is our, we can see both sides of this and we can dive into the pros and cons because it's an interesting conversation for sure, but we've always stayed private capital. Like we have not taken $1 from another company. And a lot of that is because we think it's a short-term play. We think it's a little short-sighted, especially if you end up relying on that because it's not going to be there forever.
I could tell you many stories. I'll tell you one. Customer in Arizona. He had 5 warehouse lines with 5 banks, 10 million each. He had 50 million to lend. He had no private investor capital. It was all warehouse lines. And the market was starting to get weird and things were happening and people kind of freaking out. The bank called and said, we're going to be by your office tomorrow. I want to say hi. He said, no problem. Come in. So not only did one of the bankers came by, the other 4 were with him from the other 4 banks. And they said, he's like, I didn't know this was a group thing. And they went in the conference room and they like, yeah, we're here because we're pulling the lines. And he said, well, okay, but all those loans, those monies from those lines are all tapped out and they're all in loans. And those loans are, the borrowers are making their payments. And they're like, well, that's your problem.
Yeah, they're due.
You owe me 10 million.
Those lines are due.
That's right. So well, here's the best part of the story. So he literally packed up his house. This is 09 or 08. No, it was 08. It's 08 or 07. I forget. He literally took 2 days, packed up his home in a U-Haul, got his wife, and drove to Florida from Arizona and just left. And then 30 days later, started a private money lending shop in Orlando, Florida, starting over. Now, he had the fortitude, the resources. He saved his money. He didn't drag out the inevitable. And I'm not talking, this isn't a moral question, but he walked away from the warehouse lines. And he walked away from the warehouse lines because they were calling. So to your credit, it is a short-term play to take Wall Street capital because they're very fickle. If they find a place that has better returns, they're not going to be your buddy taking you to dinner and offering you 10 million and yeah, lend it out. Yeah, we're easy to work with. They're going to say, yeah, we're pulling back on that and we're going to be investing over here now. And then you're out on the porch with no money to lend out, no way to make loans. All the capital's gone. And it's a short-term play. I always say this to people that ask. It's very enticing. Yeah. I remember when people were begging to raise capital. If they found one investor that would invest in one deal, they were just thrilled, let alone $10 million, $20 million warehouse line. But I'm telling you, you get hooked on it, and if it goes away, you're gonna have withdrawals, and it's not gonna be pretty.
Yeah, and it could be worse than that too. Like a lot of the ways that they're set up as opposed to a warehouse line nowadays is like they are underwriting and funding loan to loan.
Yes, that's true. That's true.
I've seen that movie before, only in the residential, primary residence mortgage space that we were in before we started this company, is the whole buyback thing. If they start taking a hit on a loan, and they will pull the file, find something wrong with it, and demand the lending company pay that back. Granted, it's not a $10 million line. It could be a $200,000 loan. But still, how many of those can you take?
I know. I have customers that have told me exactly the same thing. The company that the Wall Street provider that had the capital to fund a particular deal said this loan is past maturity, and yes, the borrower's making their regular scheduled payments, and yes, they're paying default interest. So it went from 8% to whatever in the teens. So they're paying that, and they're paying late fees every single month. The project's dragging on. It will sell. It's in a ritzy neighborhood. The values have gone up since the loan was written. So it's going to end up for the better for everybody. And the capital provider said, we don't care. It is past maturity. We need this thing paid. And so our customer had to buy that loan back from them, right? And they had to come up with $200K, and it was about $200K, which is interesting. So let's say they didn't have the $200K lying around.
Right.
Let's say they had to sell a loan to get the money to. So be careful of what you wish for with capital. There are no gifts without strings.
Without a doubt. And there are players involved in that kind of thing that you will never see how many layers it goes. Like, it's probably not even the person that you talk to who's making that decision, or their boss. It's another company who they have a line from, and all the way down the line. Like,
I'll give you another story. I've had people that used to do very large syndicated deals where there's like up to anywhere from 10 to 100 investors on one particular loan, right? So this is before Wall Street money. There's individual money. And so if you had 10 investors on a loan, that's one thing. 100's a different ball of wax. But let's just say the loan goes south.
Okay.
I promise you, one of those 10 or one of those 100 will not want to sell the property, or not want to do this, or not have this, or not agree. I mean, I can't get 3 people to agree where to go to dinner on any given night. So I can't imagine, 9 investors with all this money is at stake, right? So that's another thing about capital. So some people love that they can do syndicated deals, and it makes for bigger loans, bigger commission, and all that's fine and good, right? But just plan for the bad. If something goes south, what happens next, right? So one investor per loan is a good rule of thumb. There's exceptions to every rule, of course, but anyway, there's drawbacks to everything.
Yeah, and that's why for the past few years, Jason and I have been waiting for the other shoe to drop. We've been, in essence, flat on production and loan portfolio in that like $35 million range, keeping our defaults low, waiting for, and it hasn't happened yet. That's the thing. That's like the part about it. We've been leaving money on the table as people are like, 3Xing their business, and, maybe not bottom line, but 3Xing loan production, everything else. And we're kind of like staying tight and waiting for the storm. I have to say one day that will be a good decision. But in the meantime, it's like, man, are we leaving money?
I know. I'm not a cranky old guy. Like, I'm not the guy in the corner that's get off my lawn. That's not me. It's just not, that's not me.
Right.
But I can't help remember what happened before, because we had a customer that it was the biggest customer in the country at the time for private lending. I won't say their name. But they did all HELOCs, and that was their thing. They were the HELOC company. And they bought all kinds of software, and they were well known, and they had these big full page ads in the Scotsman's Guide, and they were just everywhere. And, it was like when it all went south, they were the first one to go. And if you looked at the foreclosure listings, right? So at the time, the daily foreclosure listings in Orange County, California was about 27 pages long, right? On any given day. And they had about 80% or 90% of the listings.
Wow.
I was like, oh, that's a lender. Oh, that's something else. Oh dear. Oh my God. It's all them. It's all them. And they had like 50 or 100 people on staff. They were all laid off. There's only 2 guys left. it got real ugly. There's class actions, and it was just so gross and sad to see somebody goes from so successful to just losing it all. But the lesson is, play it safe. Don't be greedy. You don't have to take over the world. Like, plan ahead, have contingencies, backup plans, think things through. Just because our money's rolling in today doesn't mean it's going to roll in tomorrow. I see new lenders coming into the business. So if this audience here is new lenders coming into the business, it's easy to get sucked into greed. Like, I'm going to do 7 projects right now, right? I'm going to have 7 loans already.
Right.
If you can handle it, and you get GCs for all of them, and you get a tight crew, and you know exactly what you're doing, you get a ton of experience under your belt, go for it. And if you don't, maybe that's not the move. Maybe it's 2. Maybe it's 1. Get 1. Do 1 great project. Make all your mistakes on 1 project and versus spreading all your mistakes on 7 projects, right? I mean, you would give better advice than I would, but I just see people get a little too big for their britches and bite off more than they can chew, and wish they could turn back time and just slow it down a bit. So my advice to the rehabbers that are starting out, I mean, Chris, have you ever had a rehab project that went exactly 100% as planned and there was no mistakes, cost overruns, contractor showed up every single time, on time, this thing is 100% under budget, we finished early, the contractor charged us less than we thought they were going to charge us, the doorknobs cost less than we thought, the hinges were less than we thought?
Of course not. Of course not. And you have to plan for that.
And you have to plan for that.
To the lenders watching this and the aspiring lenders, that's one of the great things about this business is that you don't have to be huge to make money. The margins are good.
Yes.
The points you make up front, the servicing fee. Also, let's not forget that over time, we should all be lending some of our own money. We don't have any day one. That's okay. Neither did we. And now our lender account, mine and my business partner Jason's, and that of each of our companies, our operating entities, growing those lender accounts is a big part of the plan. Add all those together, you don't have to put out $30 million a month to make a living and even have a good team. Like, you can put out, whatever it is. The smaller the operation, the smaller amount of business you have to do. But if you play your cards right, the spreads will always be good.
Yeah, and I think that's key. I mean, it's funny. In my town, there was this trophy property available. The lady lived there 50 years. It was an acre and a half, and in the middle of Los Angeles, an acre and a half is basically like Central Park. And she hadn't touched the home in that time. It's totally flat in a hilly neighborhood. It had everything on paper, like best property. It was $2 million. And my whole neighborhood and all of our friends were like, well, geez, $2 million, you could put out your dream home. And then everybody came back and said, the numbers don't make sense. There's no way you can sell a home that high end in this market. The high end market's a little soft here in Southern California. And actually take the 9 months to build that home and then sell it for 3, minus your expenses and this and that, and turn a profit to make 50, 100, or 200 grand. It doesn't make sense. There's way too much risk in it. And everybody came to the same conclusion. But those same people will gladly buy a $200,000 home, fix it up for 30 or 40, and then sell it for 350. I mean, the profit is so much better. It's less risk, less out there. They could buy 6 homes or 7 homes for that price and quadruple what they would have made on that one home in a perfect world. And I think sometimes people get a little, they're going for the home run. You know what I mean? They're going for the home run, grand slam every time. It's like, just get a hit. Go to first base, maybe still second, like you won the lottery in this one. That's great. Okay, well, just wait. Okay, now there's a batter on first. Okay, now you get 2 on. Great. Now he hits it the right field. You can go home. You know what I mean? But just play your cards right.
There's a lot to be said for that. We've both seen it over the years, and it's going to be really interesting to see what happens over the next 5 or less. Like, you attend a lot of industry events, more than we do. We show up at one here and there.
Yeah.
There's going to be a lot of folks, the institutional reps and the brand new lenders who are launching a company because there is institutional money. There's going to be many fewer people in that room in 5 years or less.
Guaranteed. 100%. And sometimes the bigger you go, the quicker you blow. And I've seen it more than I care to admit. It's funny because we had this guy before the downturn. He was, we're trying to sell him our system. He wasn't that interested, but we stayed in touch with him because we're stubborn. And he was telling us that on his investor loans, he pays the investors whether the borrower makes a payment or not. And we're like, let me get this straight. So the borrower pays,
Wow.
the investor gets paid. But if the borrower doesn't pay, you still pay the investor? He goes, yeah, we cover it. I
Yeah,
go,
most people who do that.
yeah, that's called advancing payments. He goes, yeah, we cover it. I go, why would you do that? He goes, my investors like it. I go, you know, I don't want to like throw legalese out to you, but that's technically security. If they're not tied to the asset and you're paying them anyway, that's technically a security. He goes, well, that's not what I call it. I just tell you my investors like it. And we said, you know, you just may want to look into that. And he goes, you're telling me how to run my business, sonny? And I've been around 40 years and never. I was like, okay, here we go. And so the very long story short, the market tanked. The investors that were accustomed to getting their payments, whether the borrower paid or not, well, the lender ran out of money to cover these payments. So the investor's like, hey, where's my money? They go, well, the borrower didn't pay. He goes, well, they don't pay sometimes. You always cover it. So I can't cover it now. Why not? I don't have any money. I'm all tapped. Why do you mean I don't have any money? What? I invested along with a guy that doesn't have any money? So then they call attorneys, and then they all get together. And then anyway, so he was taken over by the feds. It was in receivership. He ended up in jail, and it was ugly. And I feel bad for the guy. He did not want to hear it. And, you know, I don't know if he thought I was just trying to sell him our system or not. We just try to be nice to people and pass along information. And if they need it, they buy it. And if they don't need it, then they don't buy it. That's okay. It doesn't really matter. But part of me wishes I kind of hammered him a little bit more on that. But, you know, in hindsight, I was young to the business and he didn't want to hear it. He had 40 years on me. And he called me Sonny. Sonny, you telling me? I was like, okay, call me Sonny. I think I just lost the argument. But it happened. The moral of the story is like, be open to ideas, and don't be so stubborn and set in your ways. Like, ask other people, find things that work, find things that didn't work, do your homework. You know, don't be afraid to say no. If you have a new investor and they say, yeah, I heard you guarantee payments. It's like, you know what? We used to. Now we're tying them directly to the loans. I heard that's a better way to do things. It's better for the system. It's better for this. It's better legally. So that's what we're doing going forward. If you want to invest with us, that's great. And if you don't, that's totally okay. He still would have gotten those investors.
Mm-hmm.
They would have appreciated the honesty, right? And he should have done it when he had the chance, not when it hit the fan.
100%. It's all about setting expectations. Like your goals and that of your capital investors have to be aligned, right? And in that situation, they weren't, because that put you at odds with your capital investor, which is like the same example as the institutional money. Their goals could be very different than yours. We're going to pull all this money and go invest in another asset class.
I'm telling you, I don't know when that's going to happen, and everybody knows it will happen. I just don't know when. And so, no, and I don't. I mean, Chris, every day I'm like this. We were up 30% last year after 40 years, and then we're up 30% year to date from a crazy year last year, right? So I keep people like, you must be celebrating, high-fiving. I'm like, yeah, but I'm worried, you know. I'm like waiting for it to change, you know. And people are like, why don't we just enjoy it? I'm like, believe me, I'm enjoying it. I had a nice summer vacation. I mean, everything's good. I just know it's coming, and I just don't know when. So in lieu of that, you sock your money away, you pump up your 401k, you know, maybe don't remodel your home, like put some things off, like just trying to be smart about it. And I'm encouraging others to do the same.
Yeah, absolutely. And let's not, obviously that makes a ton of sense for someone in your position, and how that increase in business in the market and everything else would make your stuff go up. And for the lenders, we're not painting this as doom and gloom. We're painting this actually, if you play your cards right, as an opportunity, because the people who are well capitalized with the right stuff, it can still operate when institutional players pull the plug, are going to clean up at the prices they want.
At the prices they want, instead of a bidding war.
When the supply of capital goes down, the price line is going to go back up.
That's right. The rates, they're right. Absolutely. And so somebody's going to be looking to unload this property. Like, yeah, maybe before there was a bidding war and like, well, I think I can get more for it. It's like, okay. And like a year later, maybe they're like, please take it. You know, we'll give you a discount. Oh, well, we'll discount it further. Oh, as is. I mean, it might be a whole different day. But my experience is those are the people that are going to capitalize. I think the guys that have Wall Street capital are going to be gone by the wayside or drastically reduced in size. I think the companies that have investors that have been working with them a long time, that over disclose, that are 100% transparent, that guide them through what could be coming and what will happen when that comes, and just lay it all out on the table. I think those lenders will build a bucket of business and earn trust from their investors. And then when it changes, the lender adapts, you get better deals. Everybody else is not lending anymore. And these guys are going to win the lottery. I
Yeah,
mean, I just think they're good. Oh my God. Yeah. Oh,
and some
heck
of
yeah.
your, some of your best clients will come back. The guys who've been getting 8% money for the past couple of years, and like some of these people will come back around. It'll be a good spot, and that's what we are looking for too. And we definitely preach having the right capital from the right people, the people who will be with you during a downturn. Our capital investors have been through foreclosures with us. They've been through missed payments. They've been through litigation. I mean, obviously they're, on the sideline. We deal with everything, but
Right.
they have seen it all. They've been with us for a long time. And just because somebody would take a little bit less doesn't mean they're the right partner to put capital with you. Like you really have to like underwrite your capital investors just like you would borrowers.
Yeah.
And people don't do that.
Do you want every investor? No. Do you want every borrower?
Mm-mm.
No. Do we as a software company want every customer? No. I mean, I always tell the sales rep, yeah, we want every sale, of course. And then like, if we get into it, it's like, okay, we want every sale, but maybe not that guy. I mean, no, it's just like, you just want someone with the right attitude, understands everything. Like, you've over disclosed. You don't want any bullies. You don't need somebody pushing you around. You don't want somebody needy. It's going to be a phone. Chris, what's my money? Like you just want someone that kind of understands the big picture. So
right.
It's interesting. I never heard of it, underwriting your investors, but that's an interesting way to put it. And I think it's clever. I've never heard it. I never heard it explained that way, but
I don't think I've actually said that exact phrase, but that's something you learn with experience. Actually, you know what? Maybe I have said that phrase. Anyway.
Yeah, because you've got your investor questionnaire and, suitability and, you're an accredited investor, you get all that stuff. But I mean, when things get hairy, or if a borrower happens to miss a payment 1 month, or the project happens to be 30 days late, what are they going to do? Are they going to panic? Are they going to pull the umbrella? The parachute? Are they going to say, okay, thanks for telling me. Let me know. I appreciate it. Thank you. Just keep me posted. Right? You know what you're doing. They're trusting you with their capital, but they should trust you with their capital based on all the experience that you have.
Mm-hmm. And over the years, we've had probably, not a lot, maybe 3 or 4 capital investors that if something went a little sideways, or just in regular communication, we could tell that this is not the person for us. One day they're going to be a problem, and you give them their money back and you say, here you go. You're out. Go do your thing. We'll do ours. And that's only happened 3 or 4 times over the past, 11, 12 years. But it's happened, and we recognize it.
Those numbers are a testament to what you're doing. Because I'm telling you, I talked to some of the large nationwide private lenders that have Wall Street capital, and they look at our system, and I'm not going to mention any names, it's not our thing, but we talk about delinquency rates. We bring up delinquency rates, and now how are they, this and that. And we commonly hear their delinquency rates are anywhere like 7, 8, 9%.
Okay.
And I'm like, how can they be 7, 8, 9% in an up market like this, when everybody's floating and cash is king and unemployment's very low? And how is this possible that almost 10% of your borrowers are late at any given moment, and that maybe like 5% go to foreclosure? They have to, the project's not going to get done, and they're walking away. And it's like, how is this possible? Where are your underwriting guidelines? It's like, well, those guys do the underwriting. It doesn't sound like they're doing any underwriting. I mean, honestly. So the back office people are like, all the borrowers are late. They're mad. We're calling them. Nobody's making their payments. And he's like, well, the root cause of that is not good underwriting standards, but they're just trying to blow it up. They've got all this money to lend out, so they're making loans to anybody with a pulse. And I'm telling you, they're gonna be the first ones to go. I mean, you already know. You can smell it. It's just like the guy I told you about 10 years ago. The biggest guy is the first one to fall.
So like I mentioned, we get the calls from the Wall Street money trying to give it to us, and we say no politely. But I always ask about what's going on and what they're seeing. And
smart. Very good.
Yeah, I talked to a company also, I won't mention their name, but they were saying, and I've seen them at some industry conferences, and they've said that their competitors, the capital sources putting money with lending companies like ours, they're just getting more and more aggressive. And now they're doing this, and now it's 85, and now it's 90, and now it's, and they don't have to document this. And it's like, we've all seen that movie before. It was called 2006 and 7 and 8. It was in a different niche. But it's the same movie, right?
It's the same movie. Yeah, it's like Terminator 2, Matrix 2, Expendables 2. I mean, it's a sequel. And this whole 85%, 90% LTV, ARV, it's like, oh my God, were you guys not alive back then? Did you not even read? If you weren't alive, did you not read the articles? Did you see what the lending criteria was for the companies that went under back then? I mean, you heard about it. Maybe you were in a different industry, but did you not read what people were offering lending wise back then? I mean, dude, I don't get it.
I know it's interesting. And, you know, to be honest, I didn't expect this conversation to go so much in this direction, but I guess it has to be said. I mean, people should be aware of what's going on in case they weren't around during the last turn. Man, it's going to be interesting to see. And I do want to switch gears for a moment because I wanted to cover something. Like I said, this is not intended to be a software commercial for the mortgage office at all. But one thing that I regularly, because we put out content to our private Facebook group and to our email list, other lenders in our mastermind, and one of the things that I've touched on recently, a few different things, a few different aspects of the mortgage office that have been a big enhancement for us. One is paying capital investors by ACH once a week, electronically paying them, because they used to be, we used to send checks, and also it was once a month. And then we found out how easy it was. We started paying them once a week, and they get an email with a notification saying what they're being paid. We send it at the end of Thursday. They get the notification. The money hits on Friday. And it's not like it's just a check in the mail. They can directly respond to our controller by email or to me. And guess what they do? They get happy because they just got paid and they offer us more money. Or they forward the email to a friend who has been thinking about getting in, and the capital base of the right people who are friends with the people who are in grows organically. It's been awesome.
That's awesome. I hear that story basically every state all the time. Raising capital, when you treat the investors right, when you zap money into their bank accounts, when they get an email notification of deposit, or I had the guy, he was on a golf course and he just got a text. We have text alerts now too, right? So you get a text notification of deposit. He's on the golf course, like, check this out. You know, company ABC they just zapped like 14 grand on my bank account. And the guy he's golfing with is like, what? Yeah, I'm getting like 9% of my money with these guys. Like, what guys? Well, I invest in hard money lending. What do you mean? What company? And so he literally gave the lender 3 referrals with his golf buddies from being on the golf course from a text alert that he got on his phone. And so raising capital, I mean, if you don't have happy investors, then you can't make loans, right? So you want to keep them happy, but weekly is the move there. And if it's easier and it's cheaper than checks and stamps and all that whole thing, yeah. I appreciate that. I have most people that have our system, we're using spreadsheets. And so when they go to the system, they're so thrilled that their investors are so happy getting their money zapped in their account. They can see who's late and not late and all the correspondence back and forth. They're like, wow, this is fantastic. I feel more comfortable. I'd like to give you more money. I'd like to invest more with you. I'd like my friend to invest. He'd like to get down on the action. So raising capital, it's one of the points of the system, even though it's really a loan servicing system, which isn't that sexy, but raising capital, more sexy. Fair enough.
I mean, it's the whole machine. It's part of the entire machine that makes the money for the company. So, you know, like you wouldn't think that sending payment coupons are that sexy either, but they are down the line, right? So,
right.
No, and a couple things to touch on real quick. A lot of people think that they're not able to raise capital for whatever reason, like that's something that, you know, they didn't grow up with a super wealthy family, therefore they can never raise capital. And it's really not the case. Dozens of lenders out there could tell you, the people who were around before the institutional money. So yeah, a couple points to that. I mean, it gets to the point where, like I wasn't planning on pointing this out, but it did come in on my desk today. So people start, because you touch them so much, they start sending you, it's a nice check. It's a good size check. I don't want to disclose anybody's name, but I didn't know that was coming. And the reason why, and that's from an existing client. It wasn't just somebody out of the blue. But that's because of all of those touches
wow.
we have on our capital investors in different ways.
And Chris, it probably started like this, like raising capital was probably like this in the beginning. And then it kind of, once it starts taking off, it kind of feeds off itself, right?
It snowballs. Snowballs. Absolutely. And we, you know, capital was tough at the very beginning, but not that tough. We did put it together. Moving forward, it snowballed, and we never missed a loan. We were never able to not close a loan because we didn't have the money. It didn't happen. And a lot of people wouldn't believe that if you told them. And another thing, just to touch on real quick, obviously, you know, a big built out industry leading software like the mortgage office has a cost to it. So what we tell to the people who come in for training with us when they're launching or just maybe scaling, they have a couple loans out and they want to go more, is that I would probably give my best advice possible. I would probably use spreadsheets and QuickBooks up until maybe 10, 15, 20 loans outstanding.
We always tell people 20 loans when we get the call.
Yeah, it's funny you say that. And we went through a couple iterations because we tried some other software before we got to the mortgage office. But now, given our experience and what we tell people when they come in for the whole system is, get up to 10, 20, 15 loans and then call the mortgage office and cough up the money and you'll be happy that you did.
Yeah, and usually people call when they have a problem, like they dropped a prepayment penalty on a payoff, and they just ate $5,000, or they calculated something wrong and the investor wasn't happy. So that's usually when people call. So I would just say maybe call us before those bad things happen, not after. Other thing is we got a cloud version now that's for people starting out that don't want to buy our entire suite, like cool. $500 a month, get you a lot of the system. So that may be a route as well. And if that doesn't work for you numbers wise, totally agree about the spreadsheets and QuickBooks. It's not perfect and there's double entry, but at least you can manage the borrowers, manage the project, and then QuickBooks to pay the investor. So it's not ideal, but Excel's $100 and QuickBooks is like $300. So
right,
that's an option for sure.
Yeah, and make some money and know that your business is viable and real and growing, and then cough up the money in a proper system.
Yeah, I mean, I'll tell you, my wife and me are very different people, even though we've been married 21 years. And I'm the kind of person, like when I started snowboarding, I had a crappy snowboard and it was falling apart. And I said, if I stick with it and if I do really well at it, I'll buy a nice one, right? And so I did. 5 years on this crappy board, I got really good. I was doing jumps and pipes and I was like getting really good at it. So I bought myself a really nice board and I appreciated the better quality, right? Yeah. My wife is different. My wife wanted to play tennis, so she bought 7 outfits, all matching, coordinated, 3 sets of sneakers and 4 rackets, and then she played twice, she never played again. So I would say be like, and if she's listening, sorry, honey. I would say be like me, Excel and QuickBooks until you make sure this is viable and making sense, save your money, you're learning your mistakes and you're getting better at what you do. Then buy a system versus buy a system hoping the business pans out. I just wouldn't recommend that to anybody in any industry, you know what I mean? So that'd be my 6 cents on that. Totally agree with that.
Yeah, that being said, where can anyone reach you if they want to say hello, see where you're going to be at a conference or, hit you online and look into the software?
Yeah, fair enough. So our website's themortgageoffice.com. My name is AJ. I run the sales team. So you can go to our site, call me, and I'll give you one of my reps or just fill out the form online. And then we've got about 7 or 8 conferences this year all across the country, North America. So call me, tell you where we're going to be, meet in person. And if not, call me or go to the website.
Good deal. AJ Poulin, thanks for being with everyone on the Hard Money Mastermind.
Chris, thanks for having me. I appreciate it.
Absolutely. Take care.
Cheers.